Hello, today I'm going to talk to you about life insurance. Life insurance can be many different things, from a term policy to mortgage protection to final expense. We will do uh, different videos on each of these. You can also have a whole life policy. You can have a universal life policy, an index universal life policy. Um, There's also juvenile life policies. There are different requirements for each of these. Different companies also do different underwriting on each of these. Also, this is something that they do look at tobacco versus non-tobacco. Most companies, the tobacco use would be any form of tobacco, whether it's chewing tobacco, the vaporless cigarettes, whether you smoke, whether it's cigar, whether it's not cigar, um, whether you dip or chew, pretty much any kind of tobacco use, even the patches for quit smoking count. And basically, you have to have quit smoking for 2 years for most of them before you're considered a non-smoker. If it's written as a smoker, and we can go back after you've been quit smoking for 2 years and basically do a review on the policy and try to get you submitted as a non-smoker and lower your rate. The rates are determined by sex as well as age, as well as whether you smoke or don't smoke. You can be denied because of health conditions, although there are guaranteed issue products that are more expensive and more limited on how much you can get. With guaranteed issue products, you have it's a final expense product, which is a whole life for under $100,000 base amount. Uh, that basically you have to have the policy and survive for 2 years before you can die. Otherwise, it's return of premiums only. If you survive more than 2 years, you get the full face amount. Term policies, they're great for mortgage protection and credit protection. Uh, Most young people like them because they don't expect to really have to use them. I'm not a big fan of writing them for just basically to cover you if you die. I like them more as critical uh, for basically like mortgage protection, credit protection, um, because that's really how they were meant to be written and used. Um, UL and an IUL are more for retirement and building a big cash value. The UL is going to invest, basically put your money in mutual funds and stocks that are going to return a higher value. Whole Life does invest in mutual funds and stocks, but these are not expected to return as high of a value. An IUL is a different monkey. It's also known as an index universal life. The UL is a universal life. With the index universal life, you basically have some of your money put into the general fund, and the general fund basically goes into safe stuff, mutual funds, bonds, those kind of things. Then you have a section of your money that is put into um, basically an index, which can be anything from the S&P 500, the Dow Jones, any kind of index. Uh, these can offer you basically a ceiling and a floor. So you're either going to gain so much or you're going to gain so much, and basically you can only gain so much. And if the market does better than that, you don't get any more than basically your ceiling. If the market crashes, as we've seen it do in the past years, you don't lose any money, or you lose very little money or you can still gain some money depending on how the IUL is set up. Um, these policies are great for retirement because generally you're going to gain 5 to 6% every year. When you retire, you stop making payments on it, you start taking loans out. The loans are going to be at about a 4% interest rate, so you're making more money than you're drawing out. You never have to pay that loan back. Your death benefit is your collateral. If you live long enough, with triple compounding, then basically you're going to be making enough that basically the cash value will pay the loan back, and basically you'll have your a large death benefit. These can also be written on children and be used to help fund them basically through college and getting a car and getting a home, and then when they get ready to retire, they can be basically where they're sitting on in their IUL with $1 million or more, and even have also had the parents draw out for their retirement on it. Another great children's product that would be great for grandparents to get, or for even parents to get, is a juvenile whole life policy or a juvenile term policy. These policies generally cover the child up to age 18. At age 18, the child can convert the policy without having to resubmit medical proof of insurability. So basically, they get an adult policy, and they get it generally at the same rate as the juvenile policy, which is great because you get a child at 1 year old. One of these, you're talking about $1, $2, $3 at most. So basically, on any of these, you're talking about a cup of coffee a week or more. Now, when you get into the teen years and stuff, yes, you are talking 17, 18, to even maybe 30, $40 a month. Okay, so it gets a little bit more expensive the older the child is, but it's a great investment. It also teaches the child the value of investing in their life and investing in their future. And it does teach them a good, safe way to invest. This is covered under the life license, so any agent selling these would have to have a life license. They do not have to have a variable life license, but they do have to have a life license. Also under the life license, which will be covered in another video, is another retirement vehicle called an annuity. We will discuss these more in that video. I hope this brief introduction gives you some great information on basically life insurance. As I said, we'll cover more in other videos on life insurance, and we'll even talk about annuities in other videos. Thank you and have a nice day.